happy to have Tania Babina here from Columbia Business School. She studies the interaction between human capital and organizations and has some recent work on firms' investments in AI that I'm very excited to hear about. So take it away.
Excellent. Well, thank you so much for having me. By way of introduction, I studied the drivers of innovation and the economic impact. This paper specifically studies on measuring the economic impact of recent technological change, AI. We think it's important from a societal standpoint how the use of these technologies by firms are going to affect us, firms, what we do. There is a lot of theories written about it, not as much empirical work as I wish. So this paper is going to fill that gap and look specifically at the risks for AI investing firms and the investors. And this is joint work with my wonderful co-authors. It's our third paper, Anastasia, Alex, and James. All right, so AI has become one of the most important technologies over the past decade. Why? A lot driven by supply side factors like rapid data accumulation, plunging computational data storage, improvement in methods. And to fix ideas by AI, I will think how the industry thinks about AI, which are three interrelated technologies: machine learning, natural language processing, computer vision, okay? That's what I'm going to be thinking about. And what do we know so far in terms of economic impact of AI? There is already pretty solid evidence from our work and others that firms already benefited from their investments in AI in terms of gaining market valuation, sales, market shares. So that's what we're kind of already, we have many papers document showing this. How firms grow sales and valuations? Well, firms use AI for many applications, right? It's a you can solve many problems with technologies, but one common use case across all firms and industries that we documented in our first paper, firms use AI for product innovation. Create products, improve products, customize products and services. For example, Moderna COVID-19 vaccine was created with AI factor. And more generally, if you look at PitchBook reports on AI use in pharma, these firms use AI for speeding up development of drugs and many other applications. Computer vision in modern cars makes them safer. More broadly in industrial machinery, the computer vision makes machines, robots much more safer. If you're into fintech, anybody into fintech? All right, there's a couple people, great. You know that a lot of applications like credit scoring, advice applications use customized data to your data to customize prices or products offerings to each customer, right? Or your bio data on your watch, So a lot of customization, improvement, creation of products. Now, what we don't know much about, and I think it's not great, is what are the potential risks of AI, specifically thinking about broader market type implications of risks of using AI for firms. And this is where we're going to come in, and we're going to ask whether firms that invest in AI become more or less risky. We think it's an extremely important question to study, given already introduced or discussed regulation of AI. Right, so I think and what are those addressed? Typically they address risk. And if we don't have empirical evidence on the risks it's kind of a moot point to write regulation, informed regulation, right? Now, specifically, we're going to focus on the risk that is the most important type of risk in finance market, systematic risk. We're going to examine how firms' systematic risk, as it goes down or up, after their AI investments. So let me just tell you, since, how many are there people from finance? Okay, so couple. So let me just tell you about what that systematic risk is and why in finance it's the most important of concept of risk. what it is. I'm gonna call it market betas. It's a covariance of a firm's stock price with overall stock market, right? If you move more than the stock market, you are more systematically risky. If you move less with the market, you are less systematically risky. And why? From a consumption standpoint, we don't like investments that return us bad returns when markets goes down, right? This is where like the whole finance asset pricing is based on this idea. So investors care about this systematic risk and they demand compensation, right? So cost of capital will increase for firms that have high systematic risk. Capital allocation, investments will be affected if firms change their systematic risk. Now, so that's how we're gonna, there's very standard measures from CAPM for factor models. So just think of this as it's a covariance of a stock price with a stock market return, okay? Four factor means we control for other things like firm size, momentum, etc. How are we going to measure investments? We're going to reuse a measure that we've introduced in our first paper. I'm going to show you exactly how we do it, but I've tried many different ways of measuring firm level AI investments. The issue is in the US, we don't have administrative data that tells us what types of investments, technological investments firms have, especially with emerging new technologies like this. So we're going to look at share of firm workers that are AI skilled, machine learning engineers, deep learning developers. And that's going to be our proxy for firm investment in AI over time. What are we going to do? It's very transparent analysis. We don't have random allocation of AI to firms here. Working on some projects where we try to do that, but this is observational study. If you're on the genetic police, you're going to be disappointed, but it's the first look at changes in risks. We're going to look at within firm change in systematic risks, these betas, and we're going to regress it in firms' changes in AI investments and control for a bunch of things. Why is this good? Turns out these type of investments are very slow moving. There is no discontinuity. So that's why you want to look at changes over some longer period of time. Yeah.
Can I ask you about the like systematic risk notion? Like, I think about what drives like co-movement, like among various assets, and like that makes them trade like other people that would give you a high CAPM beta. So one of them is like actually you're more risky. The other is that like you kind of like standardize companies and have like a standardized input, and therefore they're like less subject to idiosyncratic shocks. They just kind of look more like other firms that are like industry leaders. And I guess what let me get to the heart of my question. Is it really important to you that it be like actually like risk as the fundamental concept, or is it okay for you if you just find that companies invest in AI just kind of co-move more with the market?
So we focus on systematic risk because it is the most important concept in finance. And for practical reason, we're going to look at measures of it that are most commonly used. Now, the way I could interpret the question, it might not be correct, let me know, is what are other things that are driving these market betas? Some alternative potential mechanisms that are not related to AI. And I'm going to talk to a bunch of them.
Well, I'm not even really like I'm not even like quabbling with like some correlated omitted variable or something like that. I just mean to say like, let's say that like AI company, like the industry kind of trades them as a basket. Like you might expect that like this happens just because they're sort of there's a lot of focus on AI. But to me that's not really sort of capturing more risk. It just means there's more co-movement in the market. I totally understand.
Yeah, I see your point now. It's actually not going to be the case. I'll show you with the data,
Okay.
which was surprising because but then, yeah, let me just postpone. So let me just tell you like, what do we expect and then start thinking about the potential mechanisms. It's actually not clear ex ante whether firms are going to have increased or decreased systematic risk. We had a project trying to understand whether firms use AI for better forecasting, right? If you can forecast better, you can adjust better to market conditions. That means you will be less systematically kind of covariant. Because our data sucked, so we're not able to answer that question. So it's still open for those who are interested and have better data. Alternatively, you can have increased systematic risk. So computer scientists have been talking about this actually for some time, about increased crash risk in firms that started investing in AI. Specifically, what they have in mind is, before, two firms learn by doing, they have their own way of doing business. They're not so covariant, maybe this way you're thinking about. And now these firms start to use same models and same providers for data, through other third-party providers churning, which can lead to this kind of crash risk when things go down. Like all of these firms are going to go down. This was my prior. An alternative better risk, which is actually we're going to find in the data, is a preview. You can have increased systematic risk driven by good market conditions. Why is that? Well, as you might, since you're at MIT, you probably all know that emerging technologies create potential investment opportunities, right? Or like economists call them growth options, right? So that's kind of well respected and accepted concept. What can be happening here is that the AIs, emerging technologies, can create these growth options. And indeed, it's kind of some supporting evidence for this. In our first paper, as I mentioned, we find that firms that invest in AI already kind of increase product innovation, right? So they're building up assets and products. Well, okay, fine, AI could potentially increase growth options, but how is this related for systematic risk, right? Well, it turns out there is a nice series of papers by our finance colleagues and UBC in Chicago that argued, unrelated to AI, that firms that have more growth options have increased systematic risk. Why? Because these growth options are riskier than assets that firms already have. So if markets go up, well, because of non-linearity and options payoff, they respond more to the market when the market goes up. Right? So these emerging growth options, they make firms risky, but not on a bad risk kind of situation, a good risk. Okay, so what are the predictions from these models? Well, first of all, they're going to be increase in market betas for AI investing firms. And this is going to, point number 3, mostly happening when market goes up, not when market goes down, right? This kind of optionality of growth options are going to increase when markets goes up. Why? Because they're more in the money, right? They're more likely to be exercised. These AI investing firms will also become more growth-like firms. So in finance, there's a concept of like growth firms that are those who have a lot of growth potential, and market kind of prices that in. And the last point is that eventually these betas should go down once these growth options are realized, right? And put as assets in place. Okay, so let me give you a preview of main results. We do find that firms that invest in AI see these increases in their betas, which are proxy or measurement of systematic risk. And so far, the mechanisms that's most consistent with this data is this kind of growth option story of these AI investments in the period we examine, which is 2010 to 2020, which is like when this is all emerging. Firms don't know whether it's going to be helpful or not, right? Like with any emerging technology. We find that there is this beta increases in these AI investing firms. Indeed, when market goes up, I'll show you when market goes down, there is not much increase in these betas. Firms that invest in AI do look more like growth firms. So their growth factor, finance people call it, like goes up. So overall, it looks like there is potential explanation for these is this AI technologies kind of create growth options for these firms, which increases their systematic risk overall. So the conclusion here is that yes, firms become risky, so that there is a distribution of consequences of these investments on, think of second moment risk, but it's not a bad risk so far. It seems like it's more benign risk. What's our contribution before I get into the alternative channels, and then tell me if you can think of any? So there are these two literatures, right? One says there is growth options in firms that they typically leads to increased systematic risk. But there is actually, we'll look very carefully, talk to some of your colleagues like Leonid Kogan in finance who've done a lot of related work. It's shockingly, or maybe not, there is no papers that actually link directly.
You got 24 hours.
All good. Depends how long this is.
There is no papers that link directly measures of technology to this increase in systematic risk. And if you know of any, let us know, because we are, it's a relatively new paper, so we're trying still to, write it up, put it in the literature. Now, what are the mechanisms that are not explaining the results? There's a bunch of them. Some are very boring, like, there could be mechanical increase in firm beta, so if they become big part of the index. It's not the case if you exclude firms that are AI investing from the market index whatsoever, still same results. Increase in financial leverage. Yes, you're not probably very boring, no? No? So firms that have more financial leverage, like debt, they mechanically become more systematically covariant because their residual cash flows become more and more cyclical. Not the case. Another potential important channel is that cash flow volatility has become more systematically driven in firms. Not the case. That AI investing firms become tech-like firms, right? Jimmy Dimon came out a couple of years ago and said, JP Morgan is now a tech firm, and I laughed. Now since I've learned a lot about fintech investments by banks, I'm not laughing, but that's kind of a story that could be happening. It's not the case necessarily. I'll show you in the data. There is the one story that kind of related to your question is, and I really was hoping to find evidence for this channel, which is like, hedge funds have been using this alternative data, the types of the week you use and all other data, satellite images, whatever, to find the firms that invest, in cool technologies. In fact, asset managers invited me to present this paper a couple of times and try to get our data. So one hypothesis was, as these hedge funds pile on, they find, because they're so sophisticated, find these type of firms that invested early in AI, right? They pile on, and then all of them have correlated shocks, right? There is a bunch of stories, intermediation capital, so they might be driving what's happening to this investing firms. We actually don't find necessarily that's the case.
Why isn't that the case? There's just enough investors that have diverse shocks.
I'll show you a test on this. All right, so now we have whole 20 minutes to go through the rest of the paper. You ready? Let's go. Okay, so let me tell you more about the data. As I mentioned, we're going to use use of AI over time, whether they hire AI skilled labor. We're going to use two data sets, one from resumes, from data called Cognism, and James, our co-author, used to be chief data scientist at that firm. That's how we got the data through him. He's a leading inventor of ML and NLP methods. It's a very good data in the absence of annotated data. So I used to work with census for worker match data, where you can see wages of all people in the US, very good data. But we don't have in any admin data for foreign worker match data what workers actually do, what kind of jobs they have, skills they have. So the best data is something like LinkedIn. So this big part of the data comes from LinkedIn and other sources where they standardize, pull them together, clean them, and make money from that data. And also help some researchers for their research. So essentially, you can see who works when over time at which firm, right? I've also used job postings. The beautiful thing about employment profiles, in fact, you were asking me earlier how I started working with Anastasia. I started this project with the job postings data that presented early stage version of the project to my senior, to Columbia finance people, and they told me you should bury the project or find better data because job postings not equal actual jobs. So that's how we were very lucky to have Anastasia and James on board. And it turns out it doesn't matter. In the paper, we'll present results from both job postings and resumes side by side. They're almost identical. So if you don't have access to finer resume data, for something like the job postings, that's just fine.
That's actually a pretty interesting, I think a lot of people would find it helpful if you just correlated them, because if we can't get access to Cognism, it's nice to know if we can use Burning Glass.
Exactly, that's what we do in the first paper. We do all kinds of cross-validation, correlations, everything is shown with both results, 100-page appendix, everything proper you do when you introduce new measure. I was surprised too that results are almost identical. So that we were trying to kind of encourage people to use the job postings data if they don't have the resume data. All right, so how are we gonna measure the actual jobs that are AI skilled or not? Turns out it's not easy. What most people have done, is they come up with a list of terms or skills that they deem as AI related. Kind of bags of words approach, right? That's what we've done. I think I've been beating my head against the computer for 2 months trying to figure out whether I have included all of them that are correct and not included, some of them that are not necessarily AI related, like data retrieval. I mean, it's related to ML, you need to retrieve data to do your ML models, but do you only need that for ML? No, right? It's very hard. Until we realized, I was looking at the data one day, and you realize that some skills empirically are very related to core AI skills, machine learning, natural language processing, computer vision. So think of, you take all the job postings, there's about 20,000 of required skills overall, and then for each job, you calculate what is the share of jobs that require this skill that also require core AI skills. It's kind of, think of this as a coincidence. And then you calculate that for all 20,000, you rank them, and then you're like, oh my God, this looks amazing in terms of conforming your extended prior. Right, so snow removal skill has absolutely zero coincidence with core AI skills. Or greeter, like in Walmart, you don't need to know ML for that, right? Or communication skill has very low coincidence. Microsoft Excel, zero coincidence with core ML skills. Deep learning, 90% of jobs that require one of the core skills require deep learning. So you can see how there is kind of correlation. So we take the list of the highest AI-related skills. That's going to be our bag of words, but essentially spit out by the data. Does it make sense? And then what we do, because the resume data is much less structured, people put all kinds of things on their profiles. So what we do then, we just search within their profile. So think of a person, job, year, company. We search for these highly AI-related skills to identify whether you at that company, at that job, at that year, whether you have AI-related skills or not. So it's dynamic, it's not static of a person, which is actually quite important because most people don't have any AI skills at the beginning of the period. So then what we have, so think of the structure of the data. We have worker by year, by firm panel, right? And then I see you, whether you're AI or not AI each year, each firm. Then we're gonna collapse this to generate firm level data. We're gonna calculate for each firm each year share of workers that are AI skilled or not. So by now, many researchers do something like this if you're interested. Share job postings to share of like resumes. It measures kind of firms, it's a proxy for firms kind of allocation of resources towards AI-related technologies. Yep.
Do you have a sense of like, is labor the main investment that firms make, or like are firms also contracting with like OpenAI and having someone else build?
Yeah, so in our first paper, your question more generally is about internal AI investments versus external AI solutions, right? IBM Watson was one of the earliest big one in biopharma. So it turns out that firms, these investments need to be complements, not substitutes. We constructed measures of internal, external AI solutions, correlated them, put them in the same kind of measure. Firms that do internal, they're also more likely to do external. When ChatGPT came out, you just can go and see a lot of companies that already had built-in ML, in their products, services. They partnered with OpenAI, with Microsoft Azure to plug in. Like I was talking to Morningstar. IBM have done that. So lots of companies just plug that into their existing solutions. Okay. In terms of share of jobs or job postings over time, it's exponentially increasing at the end of the period. This has been shown using other measures as well, where you can see kind of exponential increase in AI starting around 2013, 14. Okay, so let me show you the main results. So again, think of, we have firm by year panel of the AI investments, and we have firm level panel of their betas. We're gonna have these long differences regressions. We're gonna regress changes in betas from 2010 to 2018, so these long difference regressions on the changes in AI investments. We're gonna include a lot of controls, don't really matter that much. Sample, I want you to think of the sample as being US public firms, excluding tech firms. Well, US public firms, because you need to have stock prices. Why exclude tech firms? Well, it was kind of like a remnant from our first paper, which is like, yeah, we knew that Google's were using AI and benefiting from it. We really wanted to understand whether all the industries like finance, retail, insurance, pharma is benefiting from it. You throw in back the tech firms, results become stronger. Okay, so here is the main regression, right? Changes in beta on changes in share workers. If you throw in all the controls in even columns, and this is the pure covariance, this is covariance of firm equity with stock market controlling for a bunch of other things. You see there is robust, about 5% increase in beta. So what does it mean from an economic point of view? Mechanically, the beta of a stock market is 1, right? So you can think of being increase in 5% over overall beta of 1 of the market. I think better economic interpretation, because there is a big variance of firms' betas. Market is 1, but some betas in our samples are equal to 7, right? Some are close to 0, so there's a huge actually variation in firms' betas. So if you standardize this 5 by standard deviation, you have about 17% of standard deviation. So I mean, it's economically big, but it's not like overwhelmingly big. Yeah.
Sorry, there's someone on Zoom who has their hand raised. I don't know if it's... Maybe that was not intentional. Oh.
Zoom people, who raised your hand? You have a question?
Yeah, I just had a question. I'm just not sure if it is really a good one, but just wanted to ask that is there a possibility that there is this correlation of firm investing in highly skilled workers within this timeline of say 2010 to 2018, and that actually happens to be correlated with this share of AI workers. So why I'm asking is this, like, in order to have AI investments, you would also have a certain kind of different AI investments and AI related investment, which are more of infrastructure, sort of like having higher processing speed, like quantum computing and those kind of things. So for example, a firm like NVIDIA, right? So they might be investing quite a lot in AI, but not necessarily every job title would have, machine learning and all of those things. So I'm just curious that are we capturing this thing? I mean, is this phenomenon rather related to firms' investment in highly skilled workers, or specifically to AI, the proxy that we are choosing, which is like AI investments, which probably we may not be looking at other kind of AI investment which firms are making through this, the proxy that we have created of share of AI workers. I'm not sure if my question makes sense.
I mean, your question has like 3 or 4 questions buried in it. Let me just pick the one that I think most economically interesting from my perspective is that I agree with you, and we show this in our second paper, that AI investments require complementary investments. And some of you already mentioned this. So we show it in our second paper where we find that firms invested in AI, and we do IVs and like all kinds of things to try to get it causality, actually hire more skilled, more educated tech workers, right? Because you need to have a data pipe, you need to have data engineers who are going to integrate all of this. And you need to have more product managers who eventually on the kind of more customer side are going to handle. So you need to have a lot of skilled labor to kind of absorb and help these technologies. Now, the second part of the question, which is like, some of you already mentioned this, are you mismeasuring, is AI skilled labor a good proxy for AI investments, right? Or is there a systematic bias across industries or firms that are going to kind of make it somehow biased in one way or the other? I mean, we do a lot of things in terms of validation, our first paper, and that 100-page appendix I mentioned, but like the simple thing is like throwing in industry fixed effects by themselves do not move the coefficients that much, because if I expected like manufacturing has very different structure to AI compositions of investments versus like banking, then you can see big attenuation of coefficients, which we don't see. All right, so I have 5-6 minutes. Woohoo! Some descriptive evidence. What's interesting is that if you look at firms that invest in AI, whether they become more tech firms, they're just, their correlation with the market is driven by a bigger share of tech firms in the market, right? Or this trend in AI increased betas are more kind of general. What we do in this paper, we recalculate firm betas with the tech sector only. So think of a market just comprising tech firms, Amazon, whatever, like Google's, etc., versus their own industry, versus other industries excluding tech and in their own industry. So you can see that the coefficients are more or less, is the distribution the same, suggesting this is a much broader trend. Now, is this about AI? Paraphrasing some of your questions to some other tech happening. Because of our rich data, we can calculate all kinds of types of jobs. One thing we do is other non-AI IT investments by looking at IT workers which are not AI as our independent variable. And you can see that there is not even positive, maybe it's somewhat negative correlation between these non-AI IT investments, right? So it's not just IT that's driving this increase in beta in firms. You can do this for robots as well. close to zero coefficients. So over this period that we look at during the emergence of AI technologies, it seems like it's the AI specifically, not some other related technologies that are driving this pattern. Yeah.
When you go back to that robot bit, if you go back, if you think back to what you were mentioning earlier, like some of the Pastor Veronese models, I would have guessed that these same robot workers also, like the companies that have high robots would also be part of that, have that growth option bit. So I guess what I'm asking is like, what is the mechanism that drives the spread between your sort of core findings and this?
Yeah, I mean, all these technologies are actually quite different, right? Robotics is most, if you look at, auto or staple paper GP, I mean, it's all in automated manufacturing. It's nowhere else. So one way to interpret this difference is, from a economic point of view, it could be that the AI is very different types of technology, right? It's a prediction technology. As opposed to robots, it's a tool to replace workers, literally. So there could be economic differences in terms of why. I mean, more practically, robots during this time is not when they can emerge much earlier, and they're not as widespread as AI, which we will show. Okay, a lot of this, I'm gonna skip this. This is mostly for finance people. Let's talk about growth options. Should be enough, 3 minutes.
Until Tony,
55.
you have another 10 minutes.
Did you just say 45?
Yeah, we just want to finish up like 15
With time for
minutes
questions.
But like if the questions are integrated with the talk,
Yeah,
you don't
yeah.
need a
55 is
special
fine.
allocation.
Right.
Oh,
You're
okay.
good, you're good.
Oh! Plenty of time.
Yeah.
Maybe I'll have time to present another paper. Kidding. Okay, so as I mentioned, I think that the mechanisms that consistent with our prior findings and some of the cross-sectional findings that I'll show you could be explained by, technologies more generally creating growth options, which are potential investment opportunities for firms to invest, right? During this time, AI is that technology that's emerging that potentially creates these growth options in firms, and consistent with this, we do find, another paper that firms improve their product services innovation, kind of like monetizing these growth options down the road if they invested in AI, right? As I already mentioned, this is just a picture of like one example of like product innovation, of creation of vaccine or drugs or whatever. But there are many other examples across firms and industry where firms use them, these technologies for monetizing, improving products and improving sales.
Is there a way to sort of look at maybe even further back similar technologies to AI that could have led to similar changes in systematic risk to companies and therefore make that comparison? Or is AI sort of unique in that investment?
I don't think it's unique, and this is. So how do you frame the paper, right? One is that a broader framing is there are theories that talk about how growth options can increase systematic risk, and AI is like in a good laboratory, whatever you want to call it, to kind of test this. It turns out, we looked at literature very carefully. It's not just AI is a good laboratory, it also, we didn't find any papers before that would actually show the direct relationship between previous technologies and systematic risk. Well, why is that? Well, I don't know. People would talk to assume that there would be papers like Leonid Hogan, Andrea Eisfeld, like the best asset pricing kind of like technology people. But they don't know of any, we couldn't find any. Why is that? Maybe because there was no good firm level data on this. So we don't think AI is like super special for that channel to work. But it's just a period where we have data. Like for example, going back and testing whether the IT revolution in the 90s led to this, right? There are a lot of papers. data really sucks for that. Like our data, if you look at coverage in Cognizant data, before 2000, it's like, I don't know, 5% of people, like it's not great.
So there aren't, I guess, papers that talk about like digitization of like databases in these sort of like non-tech companies and its impact on.
Well, specifically the relationship with systematic risk, which is what we showed, right? But Veronese paper, the Jeff paper, I mean, they do talk, like, they explain something a bit different. They try to explain asset bubbles. And they do talk about potential correlation with systematic risk. With emerging new technologies, don't have the data for that. But also, like some of our findings are not as, all of our findings are not necessarily consistent with their model because they just built for something different. All right, so why there is increase in betas in firms that have more of these growth options? There is very nice theory papers that argue that these growth options, firms that have a lot of these growth options, which is potential investments opportunities, right? These growth options are riskier than assets in place. There's this kind of like mechanical relationship where if you have more growth options, your stock price reacts more when the stock market goes up, which is not going to be the case once you realize all of these growth options, right? So at some point we'll have betas going down. So what are the predictions? As I mentioned, increase in market betas, which I showed you this. AI investing firms become more growth-like firms. I'm going to show you this next. These betas mostly go up when market goes up, consistent with this kind of like positive investment opportunity kind of channel. I'll show you that, and eventually betas should drop, which we don't know if it's the right time to look at that, given all the craze with and maybe bubble with AI so far. But at some point, these theories predict kind of decline in these betas. All right, so don't focus on numbers. Focus on concepts. I know because few of you have finance background. How do we show that firms become more growth-like firms? Firms that have a lot of these growth opportunities. Finance people have this standard way of calculating this growth. It's essentially a factor. The result is coefficients in columns 3 and 4 support that the firms become more growth-like. Okay, so I'm not going to spend 10 minutes in explaining how it's done. Just trust my word. The second test that is consistent with this growth option is looking at this. So remember, beta is all it is covariance of each firm's stock price with the stock market, right? It's a covariance. But you can decompose this covariance into two components. When market goes up, kind of good beta, right? Versus when market goes down. So this is what we're going to do. We use standard methodology to look at, is your beta is going up when market is going up, or your beta is going up when market goes down? This more crash risk story. And then you can do upside minus downside beta. You can see that it's mechanical, like this column minus this column is equal to this column, right? So you can see that from economic point of view, a lot of the effect is concentrated in this like market going up and betas going up with them, consistent with kind of this non-linearity due to growth options. So that's what we have for this growth option creation through AI, which drives systematic risk mechanism. You have any other tests to support or not support this mechanism? Let me know.
Okay, so that last graph showed us that AI actually does create growth options, right? Because the coefficients on the upside beta are higher.
Yeah. Okay. Well, it's a one mechanism it has. It doesn't prove it.
Doesn't disprove all the other ones.
Yeah, exactly. So that's kind of a challenge with this paper, which is like when you don't have, an experiment, nice experiment, we can like nail down what the mechanism is. The game is to try to show a lot of evidence for the mechanism, and I'll outrule all the other mechanisms, which is where I'm gonna go next. There's like 10 mechanisms that we're trying to outrule.
Couldn't you compare what fraction of vacancies that are fulfilled versus those that are not? How that would affect the increase?
So what do you have in mind?
So let's say firms post some vacancies.
Yeah,
Some of them are filled, some of them are not.
yeah,
In some cases, the AI share of workers increases, and in some others, it
Yeah.
increases or decreases or doesn't change that
Yeah.
much. Compare these two groups against each other.
what do you wanna prove or disprove with this? Where are you going with this?
You said you don't have a clean experiment, but this would somehow
Okay, let's talk about this after I have 3 minutes. Let me run through 50 slides of alternative mechanisms. So this is a boring one. Is the effect driven by mechanical increase in leverage in this? Yeah, investing firms? No, like you can see the effects are like estimates. It's noisy, but it's the same. Is the effect driven by reverse causality? Is it the case that firms that already had a little, higher betas invest more in AI? No, it's not the case. Actually, if you look at, initial betas, like have zero correlation with like follow-on AI investments. Is this the case? So another unsurprising thing, firms whose cash flows, so firm has a cash flow each year, right? That's how we calculate present value of the cash flows and come up with a value of the firm, right? Firms that defer more their cash flows to later, right? Less cash flow now, more cash flows later, have mechanically increasing their betas because the cash flows are later. You discount them more, there's more betas. So we use measures for this, changes in cash flow durations. We don't find that that's the mechanism. So it's not like these AI investing firms essentially defer their cash flows to much later, which drives mechanically beta. Oh, so this is a test that some of you asked earlier, and it's actually a nice test that addresses a lot of different alternative mechanisms. So this was what you were thinking about. Is it the case that now, so by now, about 50% of all public firms have some AI investments, right? So is it the case that they have become more covariant with themselves and more covariant with the market, right? So what we do in this test, we recalculate market return, excluding all firms that invest in AI by our period, like it's about 40% of firms. And so beta exclude these AI firms, and if you look, it's very cool that these firms that invest more in AI become covariant even with the market excluding the AI firms themselves. Right, so it's not like all AI investing firms are now driving the returns and become covariant with themselves. This test we did mostly to kind of exclude this investor demand for cool firms, AI investing firms channel. Because if all hedge funds pile all of these AI investing firms, they should drive the correlation between AI investing firms themselves, right? Which we don't find the case. And I have 1 minute. Okay, I'm gonna skip this to be on time. We think more research is needed to understand different risk implications of AI technologies. At micro level, at market level, this paper tries to look at, at more market implications of AI. Are these firms that invested in AI become more risky? Is it bad risk, good risk, right? We talk about different stories why this would drive betas one way or the other. What we find is there is indeed increase in systematic risk in these firms, but it's not the type of risk that investors should worry about, because it's more reflective of the investment opportunities that AI investments create for these firms, which some theories predict that's what's driving the increase in systematic risk. Our findings suggest no implications of these new technologies. Typically, economists and us, our early work in try to think of this kind of like more first order first moment implications for economic effects, right? This paper also shows there is this risk implications, relocation of risk across different firms. So, done.